also a fund manager. As a fund manager, Bhuvan is managing $12 million for our clients. Since we work on a profit sharing model, the company's interests and actions are very much aligned with that of our clients. Our company's mission is to create high net worth investors and to save the retail investors. Imparting financial education and sharing Bhuvan's experience in the real world of money through such webinars is one of the ways with that we have adopted to achieve this. We have been conducting webinars once a month on various topics. These have been uploaded on the Client First Asia YouTube channel. Do watch them when you get the time. Before we get started, I'm requesting all the participants to mute their mics. Please post your queries in the chat box, and Bhuvan shall answer them either during the webinar or towards the end. Once again, we welcome you all. Over to you, Bhuvan.
Thank you, Priya. Good afternoon, everyone. Thanks for joining in. This is the 8th webinar in the series, and I'm very fortunate that I am surrounded by people like you. And stock market is also doing good for us. Having said that, we are prepared for any downturn which might come, because in any journey you have ups and downs. So a warm welcome, and this is the 8th series, and we thought let's bust the myth of value and growth investing, because a lot of us have these kind of thoughts. A lot of you have been approaching me in the past with some stock pick which you have had in your portfolio, or let's say you would have bought it, because many of my investors and friends, they buy stocks on their own as well. Am I audible? Yeah. Am I audible? Hello, am I audible?
Yeah, yes, Bhuvan.
So now I will today do also a demonstration. I think we have Akhilesh here, who is also a good friend. And Akhilesh, you there? Hi.
Hi. Yes, Yuvanji. Actually, I'm outside, so I'm keeping myself as a mute.
I'll try to make it interactive. Just a brief about us. We have presence in Dubai, India, and Mauritius. This is our journey, that how we started from a humble beginning after leaving Rag Bank, and keep learning and obviously doing mistakes. And I think you guys have taught a lot to us. And then obviously comes the legendary investors like Warren Buffett and Benjamin Graham. He has written 2 good books. Benjamin Graham used to manage the money at the 1950s. So he has written a book called Security Analysis and the Intelligent Investors. They are like Bhagavad Gita or Quran or Bible of the investing. And Warren Buffett himself is called Oracle of Omaha, who has been, I think, widely read and understood by and misunderstood by people as well. And I think today's webinar is more about what people have misunderstood him about. He is the oldest man available today. Of course, his partner Charlie Munger is as well there. This guy has been one of the conservative guys on the earth. So I think one more differentiation which I have to today unearth is basically difference between conventional and conservatism. A lot of us invest or park our money into properties and fixed deposit. That's the right word to put it, park, thinking that we are playing safe. But if you really just do a small math for yourself, you'll realize, or I will realize, or everybody of us will realize, that we have actually not been making any money in property, or let's say in fixed deposit, because they are eaten away by something called inflation, or in Hindi, it's called Mehengai. So Oracle of Omaha has been very conservative, playing very safe. He has delivered 1800 times return in the last roughly 55 years of his career. And that is what I think we are practicing here. And this is called value investing philosophy. This is a very educational webinar. As Priya rightly said, we believe in creating HNI, and we strongly feel that like there is something called green revolution, where everybody should eat vegetable. Then there is a milk revolution. Before that, Gandhiji did Namak Todo Andolan, or the salt revolution happened. I think we have a responsibility, all of us have a responsibility to create wealth. And we are responsible for that because of the wrong decisions have been taken in the path of investing. So that is what I think we have taken as a mission. And money making is just a byproduct for us. Business is just a byproduct for us. And if you have a bigger horizon or a bigger mission, I think investing is very simple. I'll repeat a common phrase I have been telling again and again. Investing is simple yet difficult. We want to make it easy, we end up making it complex. I'll repeat. Investing is very simple yet difficult. We want to make it easy, we end up making it very complex. Let's move forward. Charlie Munger is one person I've learned something from him, is that take a decision by thinking and choosing that what may go wrong. And last year we were only taking decisions in light of his philosophy that we should not go wrong. We delivered roughly 42% return on gross side before profits, before the performance fee. And we never promised that to the clients, and we still do not want to promise anything apart from a double-digit return. This year, we are already roughly up by 14% as of date. But I think this is just a small direction for a big journey of 10 to 20 years. We look forward to serve the clients and their children for the next 20, 30 years and doing the similar kind of good stuff which we are doing right now. I want to introduce a man called Ramdev Agrawal, who is an Indian billionaire. He is next to Rakesh Jhunjhunwala. I'm sure a lot of people know Rakesh Jhunjhunwala. Ramdev Agrawal ji is such a simple man I've met in my life, who has changed my life for good. And I became an equity investor. In 1990s, he used to buy a lot of companies, 240 companies in his portfolio. And he has made money also by chance because the stock market in Harshad Mehta time had a bull run. But then he also lost a lot of money in the stock market because the frenzy died down. Then he started reading about Warren Buffett. He cut down a lot of position from the stocks. And today, I think he has got 25, 30 companies in his portfolio. He has made all his wealth through a stock market. His worth 5,000 crore today.
Bhuvan, just a minute. If you can tell everybody to mute their mics. Plus, I think some people are waiting to be admitted. Or you can make me the host and I can take care of that.
Yeah, nobody is waiting because I've removed the lock. So anybody can join.
Okay.
Nobody is waiting.
Fine.
Because
Okay.
I've removed the lock in the waiting room. Let's move forward. Should I? I think.
Yes, please. Yeah.
So, what is value investing? Value investing is the concept of investing where you are buying a particular commodity, stock, property, asset at less than the intrinsic value of that particular commodity, stock, asset, business. So let's say I buy a property. It's a very simple example I'm taking. I buy a property and I desire to make 10% out of the property. When I buy the property, it should give me more than 10% because even if there is a haircut of 20% on the property in terms of the market value or the rental value, I still make 10%. So right now, when I buy with this thought that I need to start making 12%, so I need a 20% of margin of safety. What is margin of safety? Because even intrinsic value is a hypothetical, statistical based concept. I may still go wrong in calculating my intrinsic value because I have a 15% requirement. Somebody has 10% requirement. Somebody thinks risk-free rate is 3%. Somebody thinks risk-free rate is 10% or 5%. Based on that, the intrinsic value will differ. So there is always a range of intrinsic value. So let's say I'm buying a property and I need to get 10% return in terms of rental return or whatever. I should look at 12 to 14% kind of a return which I should get from the property. Then only I get into it and invest into it. I might not get that return now. I might want to get that return after 2 or 3 years. That is value investing, where things are pretty sure and you still might get 8%, but it will not become zero. What we end up buying is an off-plan property, or we have been doing it, everybody who gets into it. On top of that, we apply for a home loan. So after 3 to 5 years, we realize we are into a game of high leverage. We have bought a dream basically. So many of us, I'm sure, have seen the model flat, and then we liked it. Then they gave us a payment plan, and we all have gone for it. I'm sure 99% of us have done it, and it has been working fantastically well for us. So we still think that I will buy a property by paying 10% down payment. It will be constructed after 3 or 5 years, and my money will get double, or my money will get 1.3 or 1.5 times. Now that is a mystery investing, that is a dream investing, that could also be a growth investing. Now it all depends whether your decisions go right or wrong. So now when I will invest, or you will invest, preferably in the stock market, look at companies which are available at less than their true value. True value of a company can be taken out by knowing how much cash I'm getting back from this company. So recently we bought a company called Kirkland Gold. I'm taking the live example now. And this company is giving me 10% cash flow, or 10% of net profit. So I'm paying $10 billion. One thing I want to tell you, whenever you invest into stock market, do not see the price. See the market cap. All the billionaires, they always look at the market cap. And from there, they realize how much the opportunity can go upward. What I found is that even my HNI clients are always discussing price. And when they say, oh, price has got fallen 50%, they fell for it. What they don't realize that a stock, or what we don't realize, that a stock can not only go 50% down, it can go 100% down. So Peter Lynch gave this example in his 1994 lecture, that he kept buying, and the stock was just only going down. So price does not tell you anything, because price is a function of speculation, a short-term expectation, a news, and it could be multiple factors, and that's why people lose money. So in the value investing, we are acting when people have fear and apathy. So I met some gentlemen last week, and they told me that in March, when the whole crisis came in, we were actually out in the market to buy properties. It was a atmosphere of fear. They are ready to act. Nobody was actually interested to buy a property because people were running for their life. Market had crashed for everything, and they were looking to buy a property, and they bought it. And today they are 20-30% up in the property. Yes, that time will not come again and again in the property market. But I'm sure if we will put an effort, we'll get a lot of opportunities, and we need only few, because all of us have a limited money. So we don't need to buy 3-4 properties, or 10-15 companies in the share market, or 2 to 3 businesses when we are investing. Now there is something called efficient market hypothesis, which says that markets are perfect, all the informations are flown properly, and technical and fundamental advantages are not there. But this is actually fake. This is what they teach you in the MBA colleges. Efficient market hypothesis does not work, because one thing which is not changed in the last 50 or 100 or 200 years plus is the greed. We all are greedy. We all are fearful. The only point is, you should be greedy when others are fearful, and should be fearful when others are greedy. So that is the only difference. But the world is working. I'm sure if you know how world has been evolved as per the Hindu philosophy, that it is only progressing because everybody has a desire to multiply, whether it is in terms of children, or in terms of the properties, or in terms of the businesses. So the value investing guy will buy a particular asset when it is trading less than the intrinsic value. Intrinsic value will be calculated based on the cash flow which this company has generated in the past, and should continue to generate in the future, based on the sound understanding of the business. Now, what people are buying today? So one of, I think we have Akhilesh ji here, and he should openly discuss with us. So my good friend Akhilesh has bought a company which is called the Bill.com. Let's understand from Akhilesh ji why he bought the Bill.com. Akhilesh ji, doors are open. Please.
On करो. Wife नहीं ये on करो. ये.
Your lines are open, Akhilesh ji. Go ahead and tell why you have bought the Bill.com.
I'm audible? No, still I have not bought Bill.com. I was just seeing
Okay.
the company is actually valuation wise, and the founder of the company, CEO, who is leading he is the founder, and he did also work for institute which you refer that. So he was having he's having good experience, and he made the company, and that company is also growing, and one of the biggest also invest that portfolio manager Kathy Wood, she has also invested. She has also invested. And cash wise, what you told, also company is having good cash. That is one. And second, also by comparing that institute, its valuation is less. So that's why in my mind to can we also thought and do the analysis and all. And due to that is, and I discussed with you.
Fine, fine. So Akhilesh, thank you. Now I will just run through the valuation to everybody in very simple manner. Thanks for participating, and let's have a discussion. So audience, Akhilesh bought a company called Bill.com. Bill.com is like an accounting software. As per my understanding, it helps people to small companies to bill their customers, and you can even give the link for people to pay. It is more like a QuickBooks software or Tally, but it is a tech company, and it allows you to customize everything, and it is online, and people can work on it even from home, which is also possible in one of the biggest company called QuickBook, which is owned by a company called Intuit. Now, today, I would like Akhilesh to read this as well. Akhilesh, can you tell me the revenue of the company? Can you see this sheet?
No, actually, I'm driving, so I can see after some time.
The last year, last 12-month revenue of Bill.com is $171 million.
Okay.
Let me ask other people. They are also investors. Anyone, I would like you to name it. How much billion are you okay to pay for this company? Just asking you. Based on the revenue figure, can you just tell me, anyone, how much are you okay to pay in billions to this company? Or any million? 171 million is the sale.
Bhuvan, very, very subjective, I guess, question. Do we know the EBITDA of this company?
Good question. Thank you, Rashid. So now EBITDA of the company is negative. It's a growth company. That is the basic differentiation, that earnings are basically negative, and they are roughly $47 million negative. They're losing money for last 4 years. Now you will be able to just a rough figure is fine. I know it's not easy, Rashid, but I just want to understand from you, on a 137 gross profit, 193 171 million sale, and a loss of 47 million. How many billions or millions are you okay to pay for the company? It's an accounting software, Rashid. In fact, thank you for stepping in. You're an account person, and there are many software available in the market on accounts. So there is not a very big moat.
Yeah, look, I think Bhuvan, obviously, valuations is a very tricky topic, right? And that's what I've done quite a bit, right? In the last 15, 20 years of my life, there could be cash flow models, EBITDA multiples, asset multiples, and so on, right? Now, I don't know, to be honest, that what would be the revenue multiple you would be paying. Tech companies generally do get quite a bit of crazy valuations, right? So I'm not, to be honest, attuned to it, but looking at it, we don't know how much, potential it has already realized, right? 171 does seem quite a small number, right? In the grand scheme of the things, right? And it's growing, it seems, but not crazy growth as well, right? Over the last 3-4 years.
Growing well, they're growing by 36%. And 36%, you might get, let's say 2 years, you're doubling the revenue. So you will be having a 350 kind of revenue in next 2 years. So within 5 years, you should have $2 to $3 billion kind of a revenue, because it is doubling every 2 years as per 36% growth.
So it will not be 5 billion, right? 171 will not be 5 billion in 4 years.
170 will become 350 in 2 years. In the fourth, it will become, let's say, 700. In the sixth year, it will become 1.4. In the eighth year, it will become 3 or 5.5. In the 12th year or 11th year, it will become roughly what do you call $7 billion sales.
Hmm.
Now, any guesses? Anyone can guess how much they're okay to pay for this company? It's the tech company. It is growing very fast in terms of sales. Actually, how much are we okay to pay? Any idea? नहीं लग रहा है? नहीं पा सकते? Anybody?
Look, generally accountants and auditors are very conservative, right? To put out a number. So I'm gonna excuse myself from guessing.
So now the only difference I'm saying here is that 171 million is the present. The past is not clear because you have only history of 3 years or probably 2-4 more years because it was there as a private space. That's what a value investor will avoid doing it. What in fact value investor will look for is a 10-year history of the company and a good growth of 10 to 25% on a yearly basis. And he will also look at that the company should not be losing the money. Yes, you could be right. Akhilesh might make tons of money here, like Amazon or something, but that's what value investor will not do. That's what I'm trying to say. And I don't know, as a investment manager, I might look into this company, but you as a layman should not look at the company. You might look at the company as a portfolio, but not as a single company. But the example what I want to take here, and Akhilesh is just one person who is agreeing to coming in front of everybody and disclosing. This is what is happening in the market. People who do not have time to even read 2 pages about the company, they are only buying this kind of companies. Not a 171 million sale, not the profit. This company is available at a staggering price of $13 billion. Let's see the market cap. This is the point I am trying to make. Today's session is very unique and very special. It is not, I will try my level best to make it very easy for layman. Now look at the market cap is 13.51 billion.
Yes, that is my question. Why, if sale is less and company is not doing better, so what could be the reason for market cap? Valuation is why high?
The reason is that this is a market where you don't need a certification to invest or speculate. All you need is a eToro account or a Robinhood account, and you can take, you can do a GameStop here. It makes millions on a daily basis. It loses millions on a daily basis. In fact, I met a gentleman, and he's a good client of ours. And what I was shocked with, so this is at least it has sales, right? Now there is a company which is widely famous or notorious called Nikola. Nikola has 0 sales, and it is $5 billion because they are promising you that they will deliver a car in 2025, an electric car. My question to Akhilesh and everybody is that there could be a better company or a stable company to buy in this particular space, and that could be Intuit itself. Now, market cap is 13 billion. Your sale is 171 million, which means you are paying roughly 39 times of sales. Mind it is not 39 times of earning. It is 39 times of sales. So this is gonna make you money if at all company does what it is doing. The only problem is you will make money in 10 year or 11 year, because by the time company will reach there is a probability that company will not achieve that growth. It will sell out to somebody. There is a possibility that company will go for a toss. But your wealth creation is on a probability that the future will be good, because there is no past of this company in terms of creating cash flow for clients or investors. So value investing philosophy will call it a myth. It will basically give it a miss, and it will not invest in it. Now this is called growth trap. We call because see, there will be a crash. You all know it. You all are holding to some money. I know you're not giving to the fund managers because you all are expecting a crash. I am telling you the crash will come after 12 to 18 months, but you are holding it right away because you know the crash will come. And if the crash will come, it will only happen because of the inflation, the interest rate going high because there's too much of debt. And if the interest rate will go high and the crash will come, discounted cash flow. Now, Rashid, I want you to step in here. This company will be, every company will be valued at discounted cash flow basis.
Sorry, Bhuvan, I just lost you there. You wanted me to step in? Sorry.
I'm saying somewhere every company or every profitable company is giving you a cash flow, right, Rashid?
Yes, yes.
Discounted cash flow is something called risk-free rate and a discount rate.
Yeah, you have to use a risk-free. You have to add the industry risk and business risk, alpha, beta for that company. Yeah.
What about the 10-year treasury rate? That's called risk-free rate. Am I right?
Yes, yes, yeah.
If that 10-year rate itself becomes 5%, which company will be going down? The growth, this kind of a growth company or the value company?
I think growth will be having an issue, right?
Yes, absolutely. Now let me show you an example of the.
So, sorry, Bhuvan, before we move from bill.com, right? Just while we are on this topic, right? I think looking at $13 billion, right? Let's say if an investor is expecting the steady state return at some point, and again, as you rightly said, percentages are very relative, right? But let's say an investor would invest into an IT company for not less than a 10% return, right? His WACC should be around 10%, right? Or I should say his equity return should be 10%, right?
Right.
So we are basically expecting in today's market cap that this company would be generating $1.3 billion steady state at some point, right? You know, and that $1.3 billion, looking at a $171 million revenue, is a lot of blue sky,
Yes.
as
Lot
I
of,
see.
yeah. In fact, there are articles on this that it's a $140 billion market, but even at that, the valuation looks very much stretched. But I don't know why our attention goes that side, because maybe somewhere somebody suggests you that, or maybe marketing is happening, something is happening with all of us, and we get biased. Maybe we are getting a free advice, and not in the case of Akhilesh ji. I'm just discussing what is happening with me. And people tell me, Bhuvan, you should research this stock. I said, sir, I should research my stock with the portfolio. Should I research your stock? You are investing, you should research your stock.
Mhm.
So what I'm trying to say, and research, if research is possible in 1 or 2 days, then I should not be buying 10 or 12 companies. I should be buying 500 companies in my portfolio. Now, I don't want to make my life hell like Peter Lynch's life, and also not like Warren Buffett's life where his wife left him. I'm sure you know this. I want to lead a balanced life, and I still want to make money for myself and for clients. So this is, value investing is a sure shot formula to make money. That's what I'm trying to promote here. I'm not saying that the growth investing is not correct, but what happened is the value investing has beaten the growth investing by a huge margin up to 2000, which we will see in the next slide. But before we go to that, let's compare with an established company. I am using the software called QuickBook. It's very famous for accounting. After Tally, I think QuickBook has really done a good job. QuickBook is after Oracle's company called NetEase. Second company in the market is QuickBook. What I'm trying to say that majority of our money is lying into the fixed assets. That is a proven thing. I hardly there will be one person in this call who will say 90% or 70% the stock market for him. What I'm trying to say that this QuickBook company, which is available at a price to earning of, let's say, 49 or 50, basically you are paying $100 to make $2, which is okay, because today the bond rate is 2%, and tomorrow if the bond rate goes high, the company has the moat to increase the cost of accounting, because I don't know how many people change their accounting software. Let's again ask Rashid about this. Rashid, you have been an account person for the last 20 years. How many
Yeah.
people actually change their accounting software on a yearly basis out of 10?
No, no. Look, very few. I mean, QuickBooks, as you said, Bhuvan is targeting mid-tier businesses. Mid-tier to smaller businesses. Obviously, the big, entities listed and so on, they generally use ERP such as Oracle, SAP. But yeah, I mean, one way or the other, it's just not something you would change every year, right? You
Right.
would change, but it could be the same, ERP, newer versions, if you like. Or maybe after 5 years, you were a mid-sized company, you became a large company, your operations have grown, and you want to move away to a more sophisticated ERP. Yeah.
Agreed. Agreed. So can we say with the confidence of 70 to 80% that it's a sticky business?
Yeah. Yeah. Agreed.
Now look at the max of this company. I know some of you will say that the story is played out, but mind it, you don't have time, because when you are buying the bill.coms like businesses, you don't have time. So, and majority of your money will go to property. So if you look at this company for a 5-year period, you made 3 times, which is much, much higher than the property. What is the problem in approaching the investing in the stock market in this manner? So your property portfolio will be reduced, or your assets which are growing at 3 to 4% will be reduced, and you will be making, actually, if you look at 5 year, I'm actually made more than 30% return or 20% return, I guess. So this is what I am trying to say. For me, this company is costly, by the way. Leave me. But here the chances of losing money is close to zero. Look at the financials. Let's leave the price. Let's look at the financials. And it is all available. It is not a rocket science. It's my job is to actually give people 15, 20, 25. So that my job is even more demanding, where I will buy this company at half the price. I will buy this
Yeah.
company at half the valuation of today. That's my mandate, because I need to make money for myself and I'm driven by the performance fee. So that's what I will do. But you should do this where you have a steady revenue coming in. You have an amazing gross profit coming in. If you look at the gross profit share of the revenue, look at the operating income, you have zero interest, and the bill.com also does not have any what do you call interest and all. I'm not saying it is not good. All I'm saying is you are paying like hell to get a pie of the bill.com, and you can actually wait. That's what I'm trying to say. Or you need to buy the bill.com at the time when it was privately listed. Now, since you have little money, people don't give you access at that point of time. This is happening. Now coming to this company, they have enough cash also, $2 billion cash in the company. This is what one should do if he doesn't want to give his money to any fund manager. And he can.
Bhuvan, what's the value of this company?
This company is at $116 billion.
116.
Yes.
Okay.
And look at
And
their
yeah. What is their PE ratio?
49 forward.
49. So still there is a lot of growth assumed.
Yeah. Okay. So basically, see, Rashid, just now you told that it's a great business. It has a moat. It is profitable. It is like a Netflix of accounting, by the way.
Yeah.
I have done the comparison of product from the bill.com, and the issue is people don't change. Even if they change the pricing to $2 or $3, you can imagine the kind of money they can mint, because they have a subscription basis and accounting software everybody needs every month.
Yes.
It is the middle tier people, and they allow you to. In fact, when I send you the invoice, and if you open it, I can see that you have opened it.
Yeah.
So it gives me a lot of comfort. And the same thing the bill.com is doing. The bill.com owner has worked in Intuit earlier. In fact, Intuit is now like Amazon. It is buying all the accounting and taxing software and making a huge franchise. It is not one business. It is more than 5 to 7 businesses. I have not studied the company, but all I'm trying to say that when you guys approach, buy these kind of company, because they are still better than the bill.com. Because to buy the bill.com, you need to be really on toes, or buy a fund of like ARC investment if you really want to participate in that kind of company. I understand everybody wants to make money quickly, but this is what a value investor will look into. Then he will wait for the valuation to correct, and then he will load a lot of money with a confidence. Because the problem is, when Rashid and Akhilesh approach a company, they might put $10,000, $20,000. But when I have to invest, I have to put minimum $2 million in one company, because I'm investing for everybody, but it's my responsibility. So if this behavior can be amended, I think people will start loving the stock market. Now, anyways, that's secondary. I have also compared the R&D of both the companies, and in that parameter, also Intuit is doing a good job. And I think when Intuit has a lower sale as compared to, I'm not trying to put the Bill.com down, but all I'm trying to say that please do not invest in if and but. Invest in a company which has a steady cash flow for last 10 years, has a decent past. The promoters have been honest, because 10 years is nothing in the business industry, business history. 10 years is nothing. In fact, Rashid works for a big four company, and people like me are now approaching big four to get even audit done. So you can imagine that 10 years, 12 years is just the, teenage for a company. And that is the time the value investors start looking at a company. Now, I think I'm very clear. A strong financials, growth was there in the company called Intuit, and asset. Now, what are we trying to say here? We're saying that value comes from three things. Value comes from the earning, value comes from asset, and value comes from the growth in the sale or revenue or earning. These three things are very important. Whenever you buy a company, if you look at this three thing, and if they have all these three, I think you have found a bargain. They are very rare, and that's why our job is. So now let me give an example of this company called Kirkland Gold again. Kirkland Gold is having asset, or any gold mining company or silver mining company has a lot of these assets, physical assets. One more company we have in the portfolio, his name is Copart. It's a car auction company, and they have a huge industrial land where in the yard where they keep the car. Now these yards are valued today at a book value. One more thing I think I should ask Rashid. Rashid, why are you guys valuing the properties at a book value? Why it is not valued at the market value in the books?
So look, I think, Bhuvan, if an asset is, you have two basically categorization. One is called property and equipment. If an asset is being used, let's say for administrative purposes, right? Let's say a factory building, then typically marking it to market is not right, or what we call fair valuation, right? Now, when I say it's not right, it's not typical, right? Because the purpose is not that you're looking at the value of the asset, you're looking at the value you create from the products you make from that asset, right? So, but again, having said that, the standards, accounting standards, still allow you two options: one to keep it at cost, other to revalue it, right? Generally, from my experience, most companies go for a cost model because they don't want fluctuation in earnings from fair valuation, because that's not the purpose, right? They are not holding that land to say, oh, by the way, this value has increased by 10%. They're holding that land to park cars. Yeah. So that's why they follow cost model. But again, it was the investment property, let's say, held for rental or capital appreciation. Over there, you have again a policy choice, but generally company do opt for fair valuation, because over there you want to capture the value, right, that gets generated.
Okay, great. So the thank you, Rashid. So the difference in the accounting standard helps us as an investor to assess the real value of any asset. And that is what a value investor look for. That is what exactly we are looking for, a gap. And they are also right as an account. We are also right as an investor, because at the end of the day, we have to see, if I buy this company, how much can I sell it for, and why I will not be losing money. Because value investor always think of he should not lose the money, because making
Yeah.
the money is just a phenomena. Not losing the money is most important. So asset, here this company Copart is at $1 billion asset valuation of the real estate, and the industrial land is basically coming very close to the city, because city is expanding. I'm sure a lot of you have made a lot of money buying land near a city, and city is expanded and your land value has appreciated. So similarly, asset is something what we look at. So when we buy a mining company, a copper mining company, or any mining company, what happens is when the price goes up, even the asset price goes up. So that's one leg of value. The second leg of value is strong financials. How much cash company has, how much growth it company can give you, etc. Sorry, how much earning it can give it to you, how much kind of balance sheet and patents are there, goodwill is there, etc. Then we third leg comes from the growth. How much is the company growing their earning and their sales? Because earning and sales is everything. Your net worth will only be added if you will add the profit into retained earning, and that's how your book value keep increasing. So that is what happens in the value investing, and that is what we do. We invest majority of our money into profitable companies, or they will become profitable next year, and the share which are selling at a significant discount. We have done the mistake of buying the company at a hype, and we have also been thrashed by the market. So we are absolutely clear today, it's a public money. We would like to find only bargains. We'll still go wrong, we'll still buy a company and they will go down 5, 10, 20%. But majority of time we will be correct, and we only need to be correct in few times to make money. Now, margin of safety concept, I think I'll again explain this, which I just did. So there's a very good way of buying property in Dubai. It's called auction.com. So you go to Emirates auction, you will look at the properties you are looking at, you look at the rental yield. There are properties who are available at rent, because every day somebody or the other person is running away from the country because they are unable to pay. Every day some people are having a financial situation. I think 300 or 400 accounts on a daily basis. One local bank I've worked with, they are closing down 300 company account on a daily basis. So you can imagine the situation, the bargain available for a value investor in the property market. Second thing is stay away from the noise. So I think all this is a noise. When you get a tip, just think about it. Why are you getting a tip? Why this person is giving you a tip? And if you can just figure out that why is getting a tip, you will came to know he got a tip from somebody else. That guy got a tip from somebody else. And this tip business will only leave tip, not even leave the money to give tip to the hotel waiter or hotel or the restaurant. So that is very important. Please stay away from the noise if you want to be a value investor. When I bought this company, a gold mining company, and I bought 25% in the portfolio, actually, to be very frank with you, nobody stood by with me in terms of knowing the company. All my investors stood by with me on the basis of my research, but there were not a big investor who were investing in this company. The whole Wall Street was against the gold mining, or they were not even talking about gold. Every day the article says gold is dead and people are going for Bitcoin. Then the second thing happened is when I read Financial Times daily, I thought there'll be some good news coming in. But I think all I need is see ft.com. It seems like to me what do you call a kitty party of financial news. It is giving me only companies which are going down. One fellow called Sanjeev Gupta, who is the owner of Liberty Steel, every day his news come in, and sometime Credit Suisse default, sometime Nomura default. Every day this is coming. Not a single time ft.com has published in the last 2 months that these are the sectors people should look at where money is to be made. So I don't know why they are not publishing it. Yes, they have also given good news about the macro, but they have not really. It's so simple. Gold sector or silver sector or commodity sector for that matter is a neglected sector today. And once you print a lot of dollars, since my commodity is valued on dollar, my commodity will become costlier and dollar will become cheap. But that's what is the common sense is missing. So that is what a value investor does. He does not seek pleasure if people are agreeing to it. He does not seek pleasure or pain when people are not agreeing to it. He follows the discipline and patience. I have a very good investor and told me, yeah, last 3 weeks I have not made any money. I said, sir, last 3 weeks you have not made any money. So I said, sir, I think I told you for 5 years. And then though he's told me he's joking, but what happens is generally when we invest in the stock market, our expectation is too high. And that's why I think we lose money. We have to agree and understand that it is more like a long-term cash flow thing. And we need to buy these companies for earning dividend. So if I put $1 million today, after 20 years, let's say it become $30 million, and even a 2% dividend, I'm very happy. That is the kind of approach we have, value investor has. Now coming to the value trap. A lot of people have bought a company called Tata Motors. We also bought Tata Motors. It has gone down. It has come up to a level of $20, but it is still having a huge debt on the stock, and people are still holding it. They're liking it. They say no, name is everything. My question is, why are you not even figuring out that Tata Motor is 20% Tata Motor, 80% Jaguar? They have a debt which is 3 times of the equity. But why Tata? Why can't we just go on the road and see how many cars of which particular companies are being run on the road, and then we look at what you call 2 or 3 brands. We come and use this kind of a software which is available at $30 per year, and we just look at the sales growth and earning growth in the last 10 years, and we invest in a company. We still might go wrong, but chances of getting right are too high. Now, let me look at the debt and equity of Tata Motors and show it to you. That why I am saying so. So in the meantime, so this is Tata Motor, this is the balance sheet. Now, if you look at the balance sheet of Tata Motors, the short-term borrowing is roughly 3,000 crores, or sorry, $3 billion. Other current liability, long-term debt is $11.5 million. Sorry, $11 billion. So now we go to something called net debt. The net debt is $9 billion. That's the net debt in the company. The total debt is $15 billion. But net debt after cash or current assets is 9.9, which is $10 billion. Now, $10 billion in terms of the book value, if I just look at the book value of the company, okay, it's not given here. So I'll just go and check the market cap.
I think, Bhuvan, the equity was there. Can you scroll down?
Yeah, tell me.
I think the equity is, just common equity. Yeah. So
Yeah.
that's the common equity. Yeah.
Look at $6.8 billion, and the net debt is 10. Net debt, not the debt. Net debt is roughly $10 billion. This is the kind of leverage this company has.
Yeah. So debt equity ratio is, let's say, 17 total, right?
Yeah.
So 17, and you said 10 over 17. What is 10 over 17?
10 over 7, no. This is total common equity 6.8 and 9.9 is debt.
Yeah, exactly. So I think there are two ways to calculate debt over debt plus equity.
Sorry. 15 divided by 6, you're right. So this is basically 2.2 or 2.3 times.
Yeah.
Versus the cash was there, so I put 9. So I'm saying that, see, this is a cyclical company. It has got huge debt. But वो इंडिया मेरा वतन है और मैं टाटा मोटर्स लेके बैठा हूँ और अब मैं टाटा I will not leave Tata Motors and it will only make money. Tata Motors doesn't know you are holding it. So even if we look at the income statement, the point I'm trying to draw is that let's look at 10-year history. How is the company sales growth? Now, if you look at the company's sales growth, this is what quarterly is it? Yeah. So if I make it annual, company has not grown any sales from 27 billion to today. It is only same sales. But let's look at the gross profit. It is only double the gross, not even double the gross profit. So you will not make more than 6 and 7% this company because the gross profit, in fact, the operating income is negative. So you will not be making money because companies fail to grow the operating income. And when the interest rate will rise, this company has to pay more on the debt depending on whether it is fixed or floating rate. So this kind of stock should be avoided by a common man or a common investor. Now look at the net income. It was $2 billion in 2011 and it has become 2.145 billion. But no, still Ratan Tata is a great guy. So we will stick to the company. That is the philosophy. And same thing Tata has done in Tata Chorus also. When they bought Chorus, similar thing actually happened. But it's still, when I meet people, I made money, so I will stick to the Tata Motors. And we also did this kind of mistake. What I'm trying to say that this is the mistake which people do when they are trapped. And it's a trap. You will make maybe 30-40%, and then this is the stock you have to sell anyway. That is the point I'm trying to draw, because sales are not growing, earnings have become negative, debt is huge. One should not hold this kind of a stock. Now let's move forward. I think how much time we have? Yeah, we have 10 minutes. So this is a value trap. The example I gave you, it's called value trap. Now, second thing is Tata Motor is a very difficult business to understand because they have global presence, they have the local presence. So we need a simple business, which Charlie Munger said, take a simple idea and take it very seriously. So we would like to invest, or you should invest in a simple business, which is easy to understand. Now, what is the growth investing, which we just discussed? The Bill.com. The Bill.com is growing above the average growth potential of the sector. It is potential groundbreaking innovation. I don't know. The Bill.com might be a little better than Intuit.com. It is a hot stock for sure because Kathy Wood has bought it. Kathy Wood is a hot fund manager, not from the person perspective, but she has made good money for people. Now, when I buy the company at higher than the intrinsic value, which we just saw as a comparison of sales of $113 million and $13 billion valuation, where $500 million is cash, I think we are investing in hope. Now, there is no problem in investing in hope. The problem is when the stock will be thrashed, since you have not studied the basics correct, you will tend to sell the company. There's a company called Appian, which we bought at 30 and we sold at 60. It went to 200 and today it is smashed like anything. One of the investors called me and said that what should I do with Appian? The issue is I don't understand why you bought Appian in the first place. How can you let your money just buy something without even studying about it? And I told him to keep it, but obviously now it will take 5 to 10 years for him to even break even. The same thing happened with Amazon. Yes, we tell you to buy a company like Amazon, but 7 years or 8 years, people did not make money in Amazon because it was selling at $99. So what I'm trying to promote here is the value investor will... Hello? Hello? Okay,
we can hear you, Bhuvan.
Yeah, I just heard some sound. This is Amazon. Today, the issue is that you can't even see that in the graph. But if you ideally see that Amazon was roughly, it went up, if you can see, $93 in 1999. And even in 2003, 4, 5, 6, 7, 8, if you go up to, in fact, I'll say 9. So do you have the patience to hold on to Amazon for 11 or 12 or 13 years or to just make 10%? That's the point and you can't see it today, but this is what I'm trying to say, that stock market investing is not for 1 or 2 years. I'm repeating my example. Amazon was available at 107, like the Bill.com or any other company right now, which is actually not making enough money. Amazon was not making enough money. $107 share price in 99. It did not break even up to 2009. Are you having the patience to hold on to a company for 10 years and not making money? I seriously doubt it. That's why one should look, you should buy this company at 10 or 11 or 66 or 55, which was available in the next day. See, 21, so 16, 18. You might not be able to buy at 13, but you should be buy at 20, 25, 50. That is what the value investing does. Now, coming to the next part of the session. So, a lot of companies...
Bhuvan, just on Amazon, right? I think obviously we are now dissecting a company which we in hindsight know is sitting at $4,000. There could be 100 other companies with a lot of hype, they came, and they might be sitting at $1 now, right? Or $10, right? So I think that's also maybe would be good to get your thoughts that, how would one approach these, big hype, hot, stocks, as you would call them.
Right. So just now, last week, the fiasco of Archegos Capital, a lot of one investor gave me 3 to 4 companies, and he said, "Look, these companies are 50% down." I'm not talking about Viacom, Rashid. So there are 3-4 companies which are like educational company, and where they have gone down by 50%. My thought is very simple: that our mandate, whether it is your or mine, we all are custodian of the wealth. Our mandate is to make money. Our mandate is not to buy stocks. So one thing is avoid these kind of companies. Second thing is then buy them at a very good, decent valuation, which I'll show you now. So there's another company in the portfolio. By the way, last annual meeting when we did, we told people that we sold Appian at 60, and that time it was 150 or some 170 odd. And we told people that we don't know whether we are right or wrong, but today the way Appian has been falling, I think we are right. And maybe in 1 or 2 years, we will tell you that whether we were correct or not. So company is great, valuation sucks. Now, this is Stitch Fix. I want to show it to all of you. Our buying price is 33, 34. Yes, somebody would have bought it here also with us. 1 or 2 company we have to buy. We can't avoid it as a portfolio. But let's say you bought at 30, 35. Or let's say you have company available at 50. So my thought, Rashid, is to get into this kind of company at a lower price band. Today, obviously, that lower price band is not available. Generally, people buy these companies in the IPO. And what news you see in the Financial Times or whatever, you see a news that Square is the one of the most valuable startup, which is worth $95 billion in the private market. My question to all of you is, I've actually kept my purse here, and I want to show this to all of you. And any one person should raise the hand if I'm correct. This MasterCard logo, we all are carrying in our purse. I'm sure some of you are carrying American Express, and this Visa is also we are carrying in our purse. How many of us actually holding Visa and MasterCard? Let's see how many of hands we have. How many of us are holding Visa and MasterCard for last 10 years or 5 years or 6 years?
I haven't.
I can tell you, Rashid, I can tell you guys, there will be hardly any person. But Square.com, Stripe.com, everybody want to buy those companies. Because it is called FOMO, fear of losing out, fear of missing opportunity. This is what is happening in our mind. And once we have this fear, we just want to get in. And then since we do not have enough confidence, we end up selling that particular company. So coming to what you have asked me, Rashid, this is a company 11 years old. It is it is actually at a market cap of $4.76 billion. Can you see that?
Yes, I can.
Now I want to ask you, Rashid, what should be the sales for last 12 months? Can you put up a guess? Or a
What should be, sorry?
What will be the trailing 12-month sales?
Should be around a couple of 100 million.
Very nice. Let's do the financial analysis. We'll go to financials. Akhilesh, you want to comment how much, or anybody in my company or anybody on the audience would like to tell how much will be the annual?
I think we have discussed, so I should not tell.
No problem. Right. Anybody else? Anyone would like to participate and guess? Okay, no problem. Rashid, sales of this company is $1.6 billion.
Wow, that's 9 times my.
Yes. And it is only 2 times. Now, how will I evaluate this? I will, in the growth company, I will look at price to sales comparison of the established player.
Yeah.
And majority of my buying happened at 1.8 billion valuation or 2 billion valuation.
Yeah.
Plus, this company survived the pandemic because it's a clothing company and people were not buying clothes, Rashid, in pandemic because they were all working in their underpants.
Yeah.
And this company only did not achieve what the 19 versus 20. If you look at the difference, it's roughly what $80 million in terms of sales. 1.711. Sorry, this quarterly is it? No, this is annual. Oh, sorry, they have an August period of closing. So the difference which might come will be 50-70 million dollar odd. In the pandemic, you did a great job. You have a zero debt. You are having 230-240 million dollar kind of cash, and we actually achieved 4 times in this company, Rashid. I want to also tell you this, that this company went to $108.
Oh, wow.
And we didn't sell it. And the next 10 years, we have no plan to sell it unless and until the story changes.
Yeah.
I'm a consumer. That's how I get the confidence. And everyone should try to be a consumer. So if you look at the highest price, it is showing
But
something
now
on 90.
CEO got changed.
Very good.
Going to be changed.
Very good. So Akhilesh, that is also a half-cooked news. If you can read the news here,
August. She is
Yeah.
going to be changed in August. So
No,
that's
no,
why, yeah. But this is the plan.
but the news is half-cooked. The way the news is coming, I don't know why it's coming this way. She is becoming the chairman of the company.
Right.
So I think that's what is happening in Amazon. She's not leaving the company. She's actually becoming. So that's a very good thing, Akhilesh. That's how the news comes and become a skeptic, right? So she is not leaving the company. She's becoming the chairman of the company.
So,
And
Bhuvan, the
maybe
fact,
she's not right now. Yeah.
sorry, Bhuvan, how would you
Hello.
interpret this dropping from 108 to 46?
Okay, same phenomenon, Rashid, which happened in GameStop. People would like to short it to make more money because now retail investors are there. So these kind of things are. I think you don't need me to explain this. Every day it is coming that what happened in GameStop. So it's like a short squeeze. People see the valuation is too high. They try to short it to make money. They short it and they made the money. It's the function in the short run. It is not the voting machine, it is a vending machine. So, yeah, but it's a voting machine, not the weighing machine. So what people are doing, they are just buying lotteries and they're selling lotteries. So that's what is happening. There are multiple ways you can think. There is a algorithm trading. A lot of ways it is happening. So I'm not looking at the price, Rashid. I'm looking at the business. Now I know more about the business, but this is not the founder's portfolio presentation. So we can always discuss, and we would love to discuss the product with you whenever we will again meet. Now, the challenge is you are putting your hard-earned money, and if let's say by mistake you put in more money into this kind of growth company, they are smashed in the next market crash. You will never come back to investing because you guys are not getting time to read it because of your work commitment. That is the problem with the growth investing phenomena. Now, ideally, you should approach it in a portfolio approach. Even if you buy these companies, buy as a portfolio, like what Kathy Wood is doing. She's buying 40-50 companies, I'm sure, under the portfolio. And then your money is diversified. At the end of the day, I will tell you the returns will also be 2 to 5% here and there, nothing else. So this is what it is. Now let's hear from Warren Buffett. What does actually he's saying about value investing and growth investing? Because one thing which you need to understand that growth is a part of value. So according to him, there is no distinction of growth and value. Let me play his video. Give me 1 second. I will just put the video on.
Bhuvan, in the meanwhile, if you can just tell the participants that those who haven't registered to identify themselves either to you or to me, it'll help.
Sure. If you are attending as the unknown, I'll just request you for our record. Then on my private window, you can tell your name to me, so at least I can have a record. That is the only thing we are requesting you. Please help us to know exactly who have come. Now I'm playing the video of value investing versus growth investing, which is what Warren.
Why should you invest in stocks on eToro?
That you own a business that's going to grow to the sky, and isn't that wonderful? I don't know whether it's wonderful or not until I know what the economics are of that growth, how much you have to put in today and how much you will reap from putting that in today later on.
Good morning. Mo Spence from Waterloo, Nebraska. You've often stated that value and growth are opposite sides of the same coin. Would you care to elaborate on that? And do you prefer a growth company that is selling cheap or a value company with moderate or better growth prospects?
Well, actually, I think you may be misquoting me, but I really said that growth and value, they're indistinguishable. They're part of the same equation, or really growth is part of the value equation. So our position is that there is no such thing as growth stocks or value stocks, the way Wall Street generally portrays them as being contrasting asset classes. Growth usually is a chance to, growth usually is a positive for value, but only when it means that by adding capital now, you add more cash availability later on at a rate that's considerably higher than the current rate of interest. So there is no, we calculate into any business we buy what we expect to have happen in terms of the cash that's going to come out of it or the cash that's going to go into it. As I mentioned at Flight Safety, we're going to buy $200 million worth of simulators this year. Our depreciation will probably be in the area of $70 million or thereabouts. So we're putting $130 million above depreciation into that business. Now that can be good or bad. I mean, it's growth. There's no question about it. We'll have a lot more simulators at the end of the year, but whether that's good or bad depends on what we earn on that incremental $130 million over time. So if you tell me that you own a business that's going to grow to the sky, and isn't that wonderful? I don't know whether it's wonderful or not until I know what the economics are of that growth, how much you have to put in today and how much you will reap from putting that in today later on. And the classic case again is the airline business. The airline business has been a growth business ever since the Orville took off. But the growth has been the worst thing that happened to it. It's been great for the American public, but growth has been a curse in the airline business because more and more capital has been put into the business at inadequate returns. Now, growth is wonderful at See's Candy because it requires relatively little incremental investment to sell more pounds of candy. So it's growth, and I've discussed this in some of the annual reports. Growth is a part of the equation, but anybody that tells you ought to have your money in growth stocks or value stocks really does not understand investing. Other than that, they're terrific people. Charlie?
Well, I think it's fair to say that Berkshire, with a very limited headquarters staff, and that staff pretty old, we are especially partial to laying out large sums of money under circumstances where we won't have to be smart again. In other words, if we buy good businesses run by good people at reasonable prices, there's a good chance that you people will prosper us for many decades without more intelligence at headquarters. And you can say, in a sense, that's growth stock investing.
Yeah, if you'd asked Wall Street to classify Berkshire since 1965, year by year, is this a growth business or a value business? A growth stock or value stock? Who knows what they would have said. But the real point is that we're trying to put out capital now to get more capital money we're trying to put on cash now to get more cash back later on. And if you do that, the business grows, obviously, and you can call that value or you can call it growth, but they're not two different categories. And I just cringe when I hear people talk about now it's time to move from growth stocks to value stocks or something like that, because it just doesn't make any sense.
So I think I don't really have to say anything. The legend has put everything to the rest. And I think he has also given the example of aviation industry, where he himself has gone wrong last year, even after saying that. So this happens actually. But I think we can put this thing to the rest, because many of you have joined today for the first time, understanding what is the difference between growth and value, which even I think JP Morgan and other people are still distinguishing and telling you what is growth and value. But in my opinion, that we all are here to make more cash. So if you're giving me $1 million, if I'm putting $1 million into business, I want to get $2 million in the 5 years. That's the whole thing. So whether it is growth or value, they are all same, as long as you're not speculating in the market. So I think we are done with our presentation, and this is what it is. Now I think any questions you have, I will be happy to take it. Approach investing the way you buy inventory, you buy properties. That's what I can say.
Bhuvan, a question.
Yeah.
If a stock starts losing, if a company starts losing money, what would you do on its share price, and what are your reasons to sell for any company?
Our reasons are as follows. One reason is that when we get a better opportunity, that 90-80% scenario, this will happen. The second, coming to the business, when they're misallocating the capital. So let's say I have taken your money and tomorrow I put into bonds or I keep into fixed deposit. You will not like to, you have not given me money for that. Similarly, if I give money to a business which is buying a share at any price which is not right, or they are related party transactions, or they are not doing justice with the money, they're basically not growing the return on equity or return on capital employed at 15 to 20%. These are the time I will sell. The last scenario which happened in Luckin Coffee, I will also sell when there is a fraud. No matter what happens in the future, it might come back. But the kind of scenario which has happened in Luckin Coffee, I will be selling, because if the books are cooked, because we have to understand that I am trusting the auditor. You are trusting me, I'm trusting the auditor for his books. So I will look at who are the auditors. But if the auditors are changing, or the auditors let the book the assets in the books are misrepresented, and that is the time that I would be uncomfortable and I will be sitting on the side rather than waiting and let the price crash. Now, coming to losing money in terms of the net income, many growth companies, or many companies which are, let's say not growth companies, many companies which are becoming to capture the market, like Amazon in 1990s, or Stitch Fix now, or Appian for that matter, they are okay to lose some cash in terms of net income in the first 1 or 2 or 3 or 5 years, because they are trying to capture the market. So this is a classical example I'll give you of Netflix. Netflix was available at $10 per subscription, and those days HBO was available at $15 per month subscription. Now Netflix could have charged you $15 a month because that was the lowest subscription available, but they chose growth. They chose market capturing, and they did not increase the price. So they were losing some money in those days, but they were investing heavily into the programming. So these are some scenarios where I will sell it. That is what it is. I hope I answered to your.
Thank you.
Second, anything?
I think Bhuvan, you touched upon earlier, right? I think a couple of things that are always kind of confusing is this efficient market hypothesis. If you see something, why can't others see, right? I think that's always a kind of riddle.
Oh, very good.
Uh,
Very good question.
and secondly, I guess tied to it is you have got all these sophisticated analysts, sophisticated valuation models and so on, right? They come up with some prices, and those prices generally tend to be, again, either a mood spoiler or a mood booster, right? So how do you see these two things, and then how does that tie into your strategy of investing?
I think I'll give a very simple example. I don't know whether nowadays we are doing it or not, but husband gives money to their wife on the first of every month. Generally, it happens in the Asian culture, and they keep asking her every 5 or 10 or 15 days that I gave you that money. What happened? And wife knows that he will come back, and eventually it might happen that he might take all the money back from her by the 30th. So wife is very carefully managing the money. Husband would have lost some money here and there, but nobody questions the husband. So my role is more of that. Everybody is watching me. The good thing here is that everybody is watching me, and I also don't hide anything. So what happens is, uh, I think I lost your question, but I think your question. Can you repeat your question, because I was bang on the answer. Can you?
Yeah. Bhuvan, what I was saying is that
Why do I see it, right?
what you see, but others don't.
Yeah.
Right?
So,
Why Kirkland cannot be seen as that attractive as you are seeing by others?
So one thing is, I am benchmark on a performance basis. See, actually, you have to understand that I will also relax if my whole fee is fixed. This is how human nature is. All the salaried employees who have less on the commission, or not all, majority of them tend to take it easy. That's one. Coming to second thing is that I am surrounded by people who are helping me to unbias my opinion based on the data which is available. Now, this is not the case that people are not being offered gold mining ETF by the banks today. In fact, I'm very happy and surprised that I met some of the prospects, and the gold mining ETF was on their table. So it is not the case that people are not being given that opportunity. In fact, private banks are also offering gold mining ETF today. GDXJ is very commonly offered these days to the investors. So this is not the case. People are not seeing it, Rashid. Second, people are not reading. They are forwarding. Every day you will get this PDF, that PDF, this video. But how many of us in the last 1 week have sat down and listened to a great investor for 1 hour? And if they are listening, then they are seeing. Just to take example of, let's take your example only. How much busy are you at work?
Quite busy.
This is the reason, nothing else. I am not a rocket scientist. Investing is a common sense. Anybody can do it. You are outsourcing your time to me, nothing else. Third thing, I think we are today walked up by these options of WhatsApp and Facebook and Twitter. We are bombarded with information. We just don't know what is the right thing. I think early days were great when people had less options. Today, we don't even remember 10 days back what did we do, because I think we are trying to do too much in life. We should take few decisions, and we should take the good decisions. So why I'm able to see it is because I have done those mistakes, and I've realized that for everything there is a manual. Everything there is a manual. So just now I've ordered 10 books, Rashid, of investing, and I'm going to read them not once. I'm going to read them at least 5 times. So I'm also learning right now. So when I did this gold mining company, my team has gone to 45 companies and did the data analysis, and we were about to buy something else, but then we got one more jewel, and then once we bought the jewel, we realized this is a better opportunity than the company which we have shortlisted. We would have made money in both the cases. We could have bought both the companies, but since we want to make sure that our efforts are concentrated, we bought only one company. So it is not that anybody cannot see. Are you saying people are not able to see Tesla? But probably buying Tesla car will give us more pleasure than buying Tesla stock. and holding it for 5 or 10 years. So this is the only reason. Everybody is seeing what I'm seeing.
Yeah. No, so Bhuvan, my question was more on the valuation. And secondly, it's not people like me, as you rightly said, who may know a few things about valuation, but don't have time to research and sit and so on, right? I'm talking more about the sort of funds, right? Who basically are sitting, who buy, that's what they do for their day job, right? So why can't they see the value in some of these stocks as you are seeing?
So I cannot tell about them. I am seeing it because I'm reading the books and they are telling me exactly how they have seen the value. And I am actually doing what they have done. So Peter Lynch has given out everything, how he has selected stocks all his life. He has clearly said that price to earning of a company is 25, and if the share price is grown less than 25%, then this could be a good share to buy. He has clearly given that if the owner or promoter of the company is buying the share, you should buy. So Continental Resources, when we bought, the promoter was buying the share. He is 80% owning the company now. He was not owning the company earlier. So there are some principles which has been clearly laid out. And if I see that principle, everybody can see that principle. The question is, are we in hurry to buy, or we are actually have a checklist to make sure we tick the checklist before we enter into the transaction? So I see in terms of value because I read these books and they tell me how they have done it. So I just do that, what they have done it. Right?
Yes, yeah, no, Bhuvan, that's fair. Yeah, I mean, I've got some ambiguity, but I'll pick it up offline with you.
Any other question we have?
No, Bhuvan.
Okay, I think that I have taken enough time. Guys, thank you for joining in. It was great pleasure learning from you. I'm available and my team is available whenever you need. Invest is very common sense. 99% of it's common sense. It is just that we all are. There's a book called Atomic Habit, and once you start trading, you just want to trade. Once you want to time the market, you want to time the market. Basically, time the market we might work for some people, but this is a brand. You're buying a brand, you're not buying a commodity. And once you buy a brand, like every company is a brand, because the moment Apple new phone comes, you buy, right? Till the date you are buying Apple phone, or you are every day in the evening you will switch on the Netflix through your remote. Or today right now I'm using Zoom, or somebody is using Apple on their laptop to have this presentation done. I think these companies will continue to grow. The only thing is valuation, which might be there, and if you want to overachieve and put large chunk of money, you will look at the valuation. Else, just buying these companies also might make you good money because they have established track record. We are so addicted to them. So timing the market may not work here. Approaching in a value investing phenomena will guarantee the success. You might not make 100% return, but you might make 15 to 20% return on a year basis. And I think that's the key to compound your wealth. I don't know how many of you understand the compounding math. I do it on a daily basis. And I think in the next 20 years, the portfolio should be at least 30 to 50 or 60 times. That's the whole idea. Thank you for joining in and have a great day and see you on the road.